This is question 4 of homework 4, calculating project NPV. So this is another example of we're provided with all sorts of information that we need in order to estimate the annual cash flows of a project. And then after that, we need to calculate NPV of the project. You have been hired as a consultant for Pristine Urban Tech Zizzer. PUTZ, manufacturers of fine scissors. The market for scissors is growing quickly. The company bought some land 3 years ago for $1.35 million in anticipation of using it as a toxic waste dump site, but has recently hired another company to handle all toxic materials. Based on a recent appraisal, the company believes it could sell the land for $1,450,000 on an after-tax basis. I forgot to mention that based on this information, they bought some land 3 years ago for $1.35 million, because this $1.35 million was incurred 3 years ago, so that was a sunk cost. So we shouldn't include this cost in our cash flow estimation, because all the cash flow estimation should be done for the future cash flows. But based on a recent appraisal, the company believes it could sell the land for $1.45 million on an after-tax basis. So this sentence tells us the opportunity cost of taking on this project. Because if we don't take this project, we could simply sell the land, and this is the price we can get. But if we take on this project, then we couldn't sell the land at this price, even though we may be able to sell the land once the project is done. So let's go on to read the setup. At the end of the project, the land could be sold for $1.55 million. So this is what we just mentioned. By taking on this project, even though we will lose this opportunity, but we gain by this price. Yeah. The company also hired a marketing firm to analyze the scissor market at a cost of $120,000. So this is the point which is easily missed. Should we include or not include this cost of hiring the marketing firm? So we have to be very careful in rating the setup. Actually, I made a mistake myself when I first did this question. So this is the second time I'm doing this question. That's why I know this is a mistake that's easily to be made. So the key point of this sentence is this hired. So it's a past tense, means that it's already incurred. This cost is already incurred. But as we said, what matters is the future cash flows, or the cash flows which haven't been incurred yet. But this cost has already been incurred. That's why they used hired, rather than is going to hire, something like that, or intends to hire, something like that. So that means this cost is also a sunk cost. So we shouldn't include this cost in our cash flow estimation. That's a very important point, and also a very easily missed point. An excerpt of the marketing report is as follows. The scissor industry will have a rapid expansion in the next 4 years. With the brand name recognition that PUTZ brings to bear, we feel that the company will be able to sell 3,300, 4,200, 4,800, and 3,700 units each year for the next 4 years, respectively. Again, capitalizing on the name recognition of PUTZ, we feel that a premium price of $600 can be charged for each laser. Basically, these two sentences tell us how to calculate the revenue or sales. Since lasers appear to be a fad, we feel at the end of the 4-year period, sales should be discontinued. And the last sentence simply tells us the project will be a 4-year project. PUTZ feels that fixed cost for the project will be $400,000 per year, and variable costs are 15% of sales. The equipment necessary for the production will cost $3 million and will be depreciated according to a 3-year max schedule. And later on, if we go to this table, we can check the annual depreciation percentage based on this 3-year max schedule. And at the end of the project, the equipment can be scrapped for $375,000. So this is the salvage value of this equipment, but it's before tax. So we need to subtract the taxes and the firm has to pay. And how do we calculate the taxes? So the tax for the salvage value is simply the difference between the selling price of the equipment after the project, which is $375,000, and the book value of this equipment after the depreciation. But you can find that the 3-year max schedule actually will be fully depreciated in 4 years, and the project will last for 4 years. So by the end of the 4th year, the book value of the equipment will be 0. So that means the taxes for the salvage value will basically just be the selling price minus 0, right? 0 is the depreciated book value, and then times the tax rate, 38%. A net working capital of $120,000 will be required immediately and will be recaptured at the end of the project. And we are given with the tax rate and the required return on the project, 13%. And that's simply the discount rate. And what is the NPV of the project? So to get the NPV, we need to first estimate the annual cash flows. And to estimate the cash flows, we need to first get the operating cash flow, and then we do the two adjustments, right? If you pull out my PowerPoint lecture slides, section 4, you can see how we calculate the free cash flow. So we start from revenue, right? Get input. Then we start from we determine the operating cash flow, and then we determine the investment and working capital needs. That's the net working capital, and incorporate after-tax salvage value. And if there's any opportunity cost, we also have to consider that. So that's basically what we need to do. So we start from operating cash flow. In order to calculate operating cash flow, we need to first go to the sales, right? Sales. So we first get the year year number, year 0, year 1, year 2. Actually, you can just pull this to the right, and where Excel will automatically number the year. So we start from unit. We provide it based on the information. The unit will be 3,300 for the first year, 3,300. For the second year will be 4,200. Third year will be 4,800. Fourth year will be 3,700. And we also need to get the price. Price will be 600. And I give a name for this 600 sale value, just price, because later on when we do the sales calculation, we can just multiply the unit by price. If you don't name this, and if you just multiply the sale value, then when you pull the cell all the way to the right, Excel will think the second value will be the second year's unit times the value right after this price, and that's not what we want. So that's the reason why I want to name that price. So you can see every cell, Excel will just keep the name. So that will be, the sales will be correctly calculated. And then we subtract all sorts of expenses. Start from the fixed cost. Fixed cost will be 400,000 every year. So this will be the same. So I just pull the cell all the way to the right. And variable cost will be a percentage of sales, 15% of sales. And again, pull all the way to the right. And then we need to get the depreciation, annual depreciation. In order to get the depreciation, we start from equipment. The equipment cost will be incurred in current year, 3 million. So annual depreciation, we're simply I also need to use a name for that, equip cost. So now annual depreciation will be based on a 3-year max schedule. 3-year, first year is 0.3333. 0.3333 times equip cost. That's simply the first year's depreciation. And second year, go back to the max schedule, 0.4445, 0.4445 times equip cost. I forgot the equal sign. And go on, third year percentage is 0.1481, 0.1481 times equip cost. Again, I forgot the equal sign. Finally, fourth year 0.0741 times equip cost. So that's the depreciation. So now I can calculate the EBIT, earnings before interest and taxes. That will be simply sales minus fixed cost minus variable cost minus depreciation, and then pull all the way to the right. And because we take care of the interest in the discount rate, so when we estimate the cash flows, we assume there's no interest expense and there's no debt. Hence, EBT is simply the EBIT, earnings before taxes, because the interest expense will be 0. So EBT is equal to EBIT. And then tax rate. Tax rate, go back to the setup, will be 38%. 38%. Again, I put a name T rate to stand for this tax rate. Now, taxes will be based on EBT times tax rate, and pull all the way to the right. Now, I can calculate net income, which is basically EBT minus taxes, and do this for every year. So finally, operating cash flow will be net income plus depreciation. And do this for every year. So now once we are done with the operating cash flow, we need to take care of other cash items of this project. So, and the first cash item is the equipment cost, and that's a negative cash flow. And then the second one is the opportunity cost of the project. And if we go back to the setup, we are told that the company believes it could sell the land for $1.45 million. So that's our opportunity cost, and it's 1.5 thousand, $1.45 million. But by taking on this project, we also gain by the right to sell the land for $1.55 million by the end of the project. So we should include, this is also our opportunity cost, but it's a negative opportunity cost, which means it's a positive cash flow for our project. So it should be $1.55 million. So it should be this one, opportunity cost. It's the both should be included. And then the next item will be net working capital. Current net working capital level will be $120,000. And this will be the same every year. Why it's the same every year? How do I know it's the same every year? Because the setup mentioned that the net working capital of $120,000 will be required immediately and will be recaptured at the end of the project. So that means this level of the net working capital will be recaptured by the end of the project. So that also tells us this level is maintained to be the same every year until the last year. The last year will be captured. That means the last year level will be 0. So now we do the change. What matters, remember, for the net working capital, what matters is the change, not the level. Don't forget about the change. So the change is simply for the current year, it's the current year minus an after sale, which is 0. And you can do this calculation, but as we said, all the intermediate years will be 0, the change. Okay, so the last item will be the salvage value. The salvage value. Salvage value is by the end of the project. The before tax will be $375,000, and after tax will be this before tax, the selling price minus taxes. As we said, taxes will be based on the difference between the selling price and the depreciated book value of the equipment. But because the depreciated book value of the equipment will be 0 after 4 years depreciation, so the difference is simply the selling price. So it's this number again times tax rate. So that's the after-tax salvage value. So are we done with all the cash flow estimation? I believe so, but let me double check. Because sometimes if you don't double check, it's easy to miss something. I believe so. Yeah, I believe we are done with all the information of the project. So now I can calculate the free cash flow. Free cash flow will be operating cash flow. For the first year, for the current year, it's empty, so it's 0 minus the equipment cost, and then minus the opportunity cost, and then minus the change in net working capital, and then plus after-tax salvage value. Yeah, that only applies to the last year, but I can include that number now because later on when I put the cell to the right, that number will be included. Right now it's empty, so it doesn't affect my current year's cash flow estimation. Yeah, I believe that's the number I need. Doesn't look like to be right. So let me double check. Where do we get it wrong? Oh, yes, that's where we need to be super careful. Yeah, because when we calculate the depreciation, we named the equipment cost to be the equip cost. So when I include the cell here, Excel automatically just use the name. But here, actually, when I calculate the free cash flow, I don't want to use the name again because I want the cell number to change for every year. But if I use the equip cost, this the name of the cell here, this won't change. So I need to change this back to be C7. C7 is equipment cost. So now when I pull all the way to the right, you can see every number becomes positive, right? Starting from year 1. That makes sense. So now discount rate, it's 13%. Again, I give a name for that, it's a D rate. And finally, I can do the NPV calculation. NPV equals NPV, open parentheses, first argument is rate, basically is this discount rate. And the second argument is values, value 1, value 2, and value 3, yeah. So this refer to the cash flows, but the rule for the NPV function in Excel is that the cash flows need to start from year 1's cash flow. So that means we start from here and pull all the way to the right and close this. But obviously we left out the current year's negative cash flow. So after this NPV function, we still need to add the current year's cash flow and a negative number. That makes sense. Otherwise, we need to subtract a positive cost from the NPV. So yeah, that's the final number. I just need to copy this number to my cell and make sure we get rid of the dollar sign because we already have the dollar sign before it. And now check my work. Yes, now you can see it's correct.